Hi everyone. We're going to do a quick voiceover on some slides to kind of give some examples of some of the accounting concepts and principles that you've read about in your reading. For those of you who have worked in accounting or have studied accounting, some of these terms might be familiar, so this may just serve as a quick brush up. For those of you who are new to accounting, this handful of slides basically is intended to level set some of the conceptual understanding that underlies all financial statements, regardless of whether you're looking at Harley Davidson, Kohl's, Starbucks, or even your own employer. So the first concept we're going to talk about is the accounting entity. You'll notice when you go to the SEC website and you download the annual report and financial statements for the company you've selected, the first line on those in the financial statement part of the report indicates the legal entity that this financial report relates to. So that might be Starbucks Inc. It might be Harley Davidson. It might be your company that you work for may be owned by a larger company or a conglomerate or holding company or something to that effect. But one of the first things you do in a financial statement analysis is understand, okay, what legal entity does this set of financial statements relate to? So as you look at your set of financial statements this week and next, or over the course of the semester, just take notice of that name at the top of the page and become familiar with who it is, and that is ultimately who all the financial information relates to. The second concept we're going to talk about is the going concern concept, and that all financial statements are published with the expectation that the company is going to continue into perpetuity. If there's any doubt as to whether a company can continue for another year, their auditors are required to disclose that in their audit report. So for each of you who are looking at your annual report, you probably notice that there's an audit opinion from an audit firm for each of the companies that you're doing. If any of those audit firms had any doubt as to whether the company can continue for another year, they would be required to publicly disclose that in their audit report. Now, I'm fairly certain the companies we're looking at are free from that. Might be interesting to check the audit report of your employers if they do one, just to make sure the auditors think your employer is going to continue for another year. The third concept we'll talk about is unit of measurement. So in all the financial statements we'll be reviewing this semester, the unit of measurement is denominated in a currency unit, in our case US dollars. So even if Harley Davidson or Starbucks, they do a lot of international business, even if they denominate a sale in pesos or euros or kroner or whatever else, they have to translate that back to dollars. You can imagine financial statements would be just incomprehensible if we started mixing currencies, if they started keeping, if Harley Davidson started reporting in something other than dollars, such as the number of motorcycles on hand, it would quickly become incoherent. So all financial statements are reported in the unit of measurement, typically a currency, and in our examples this semester, that unit of currency is US dollars. The fourth principle we'll talk about is the cost principle. Basically, this means that transactions are recorded at their original cost to the entity as measured in dollars. So if you think about the property that Harley Davidson owns off, I think, Highway 45, they might have bought that property 100 years ago at maybe $25,000. So that $25,000 cost is reflected on their balance sheet as an asset. Now, you and I both know that that land is worth a lot more today. It could be worth several $1 million more today. But Harley Davidson is not allowed to kind of mark up the value of that asset for the realizable value, I guess you could say, or the market value. All financial statements are recorded on a cost basis. So that's one of the limitations of financial statements. You can imagine Harley Davidson would like to report a higher asset value, but the normal accounting concept and principle and accounting convention is to record it at a historical cost. The next principle we'll talk about is objectivity. the accountant's desire to have a given transaction recorded in the same way in all situations. And having worked on the front line of an accounting function, I know that if a quarter is tight and it doesn't look like we're about to make our number, there might be some temptation to change the way we've historically accounted for something. You can probably tell your ethical instinct should be kicking in. That's not appropriate. Ideally, accountants should be recording all transactions using an objective kind of arm's distance approach. This way they do not give in to temptations to meet numbers or any of the pressures that they might be feeling. Another concept we'll talk about, or that underlies the financial statements, is the concept of the accounting period. So if you look at your financial statements for Kohl, Starbucks, or Harley, you'll notice that each financial statement has a distinct accounting period associated with it. So for the balance sheet, there is it demonstrates the financial position as of a point in time. So this is what we own and what we own as of December 31st, 2012. And that is called the fiscal year end. For the income statement, or the statement of operations, or it's also called the profit and loss statement, that is for a period of time. So you'll see that runs from, say, January 1st, 2012 to December 31st, 2012. So it's a 12-month period. And the accounting periods can vary. Usually there's a disclosure in the financial statements if there's any nuance to it. And Kohl's might be a good example of that, since their fiscal year ends vary from year to year. Next concept we'll talk about, and I think this is a very critical one, is the matching concept. So the idea here is all expenses incurred to generate that period's revenues should be deducted from the revenues earned. So take a look at your income statement. If you're looking at Kohl's income statement, you'll see that they have sales revenue from the things they sell. So they might have sold me a pair of shoes for $100, which is recorded in their sales line. If that pair of shoes cost $50, they have a related cost of goods sold that is deducted from that revenue. And if the salesperson earned a commission on that sale or salary on that sale, that would be they would match that commission expense or salary expense to that sale in the same period in which the sale was recorded, typically in the selling, general, and administrative expense line. So the general idea of the matching concept, it applies to the income statement, and the general idea is for every dollar of revenue, you want to identify the associated expenses to generate that revenue. So remember, I tend to think of revenues in terms of the effort or the accomplishment, and then expenses being the effort to achieve that accomplishment. So we always want to net the two to arrive at net income. The next concept we'll talk about is accrual accounting. And again, this is extremely important to understand this concept. Basically, we recognize revenue at the point in which a sale commences, and we recognize expenses when incurred, even though cash receipt or payment may occur at another time. So think about if you were to buy a motorcycle from Harley Davidson. Typically, you would buy the motorcycle, you'd get the motorcycle, and you might pay for it in cash over 36 months. So in that case, it's appropriate for Harley Davidson to record the sale when they give you the motorcycle. They've done their part. They've delivered the motorcycle in exchange for a promise to pay over 36 months. So under accrual accounting, they could accrue that sale at the point the motorcycle transfers to me, regardless of the fact that the cash is going to come in after the fact. Consistency, again, this concept is critical. You can imagine how incoherent your financial statements would look if fiscal year 2012 was recorded using a different set of standards or principles than in 2011, and 2010 was different from 2009, and so on. So accountants are required to be consistent from period to period. If something, for whatever reason, changes, usually that's disclosed in the face of the financial statements. Sometimes you'll see a line item, the description might change from 2011 to 2012. So those are things you'll almost certainly run across with the 3 companies that we're studying this semester. Next concept we'll talk about is full disclosure. If there's any big event that underlies a company's financial statements, it's required that they disclose it. So a good example of that might be what Starbucks went through in 2013. If you look at their income statement, there was a big legal charge. I think it was described as legal and litigation expense. So when it's that significant, I want to say it's several $1 million. I can't recall the exact figure. But when it's that significant, it's disclosed in the face of the financial statements. If it's significant but not significant enough to disclose in the face of the financial statements, it might be disclosed in the notes to the financial statements or the discussion and analysis that management does of the financial statements. But in either case, if something is significant enough that it piques your interest as you review the financial statements, it should be disclosed. The next concept we'll talk about is materiality. Although accountants have a reputation for being penny pinchers, their ultimate obligation is to record and report transactions that are either individually material or collectively material, and by that I mean meaningful to the audience. So although we get that reputation for being penny pinchers, at the end of the day we have to maintain a big picture view. And then last concept on this slide is conservatism. Generally speaking, accountants are required to have a conservative outlook, especially when making judgments and estimates. If they get too greedy, so to speak, they could really distort the shape of their financial statements, and that is generally conservative, or that is generally discouraged. As an auditor, when I used to audit companies, I used to have to push people on this when they were being what I thought was a little aggressive on their estimates. This slide touches on that accrual concept again. So accrual, again, when you think about your income statement, the financial statements you'll be looking at, revenue is recorded when it's earned at the point of sale, services, or products. So when you deliver me a cup of coffee, that's earned, even if I don't pay for it until a month from now. When you sell me a pair of shoes at Kohl's and I walk away with that pair of shoes, that is earned. You don't have to wait to record it until I pay cash, which may not be until a month afterwards. Similarly, expenses are recorded when they are incurred. So if I worked on a Thursday afternoon selling shoes at Kohl's, that expense for my time has been incurred, even if they don't pay me until 2 weeks after the fact. And then lastly, I'm just going to touch on some of the limitations of financial statements. First, significance of estimates, where the art of finance comes into play. So we've done a lot of reading on that, and we'll go into that a little bit more over the next coming classes. Secondly, they do not reflect qualitative variables. So an example of this would be at Fiserv, where I used to work. We hit an all-time high in terms of stock price. Our financials never looked better, but we were also rated by Yahoo Finance as one of the top 10 worst companies to work for in the same week. So they don't really, that employee morale, as an example, didn't really show up in our financial statements. Another example related to Fiserv is the concept that some things can't be objectively measured. So we acquired companies that had little to show for their assets other than desks and office supplies, but we acquired some really smart technological people and programmers, and that doesn't show up in the financial statements. The disconnect between book value and market value we talked about, the comparability between companies, I think we've touched on that a little bit, and opportunity costs, I think we'll continue to touch on it. But for the time being, I think this gets us started with all the concepts that underlie the financials we'll be looking at this semester.